Yeah, so I'll jump in as I know that everyone is very busy. We can get to the real meat of the webinar. Thanks so much for joining. How to profitably manage your 1P Amazon business and also find the right talent for your team. I'm Lauren Stiving. I'm the founder of Ellis International, and we're a global executive search and talent development firm specialized in the digital and e-commerce functions within FMCG and retail. I was originally introduced to the function about 10 years ago when FMCG companies started having key account managers for Amazon, so the very early stages of e-commerce. We continue to work with large blue chip multinationals, placing heads of Amazon for consumer electronics companies selling up to $500 million on Amazon. So we've heard many times from our clients that how challenging it is to profitably manage their business with Amazon. And for that reason, we've invited Martin Heubel here today with us. He's a strategy consultant for Amazon vendors based in London in the UK. He's a former senior manager at Amazon and has led several FMCG categories and helped companies like Nestle, PepsiCo, and Mars to successfully sell online. And after 5 years at Amazon, he transitioned into his role as an independent consultant back in 2021. His consultancy firm, Consultus, works with clients across Europe and North America, providing tailored advice for brands seeking to increase their profitability with Amazon. So welcome, Martin.
Hi, Lauren. Thanks a lot for the introduction and very pleased to be here. Hi, everyone also in the chat and all of the participants. Thanks for joining today. I think we're in for a very exciting session and feel free to drop your questions in the chat. We will also have later onwards, I saw Pablo was already mentioning it in the chat, set aside some time to go into the details.
Great. So yeah, Martin, please take it away. I'd love to hear what advice you have. I know we're going to be looking at, the KPIs you should be tracking, how to manage pricing, how vendors can improve margins.
Yeah, I think to really set the scene, right? I mean, everyone is in the current macroeconomic environment facing and really literally feeling how squeezed margins look like. So I think it's important to not only cater to the Amazon business model itself, but also to kind of really understand what is going on in your P&L and how you can also ensure that you are doing the right things in order to elevate your profit margins over the mid and long term. It's not all about the short term. So I brought today 3 key areas that you need to focus on in order to really elevate your profit margins in the short, mid, and long term. And hopefully that will also spark some ideas for you to think a little bit differently about how you can manage your business with your vendor manager, but also with Amazon itself. And the first part really of these 3 points and 3 key areas are that you have to know your KPIs. And I know it may sound boring to some, but I cannot emphasize how important that is. I see it all the times also among my clients, that often the basis for a data-driven decision-making is not even there because they're either not looking at the right KPIs or they're only looking at some KPIs that they should really look into in order to fully understand what is going on in their P&L, or they're only looking at it when actually things have gone wrong. And I think here it's really key and crucial that you're not only setting up and defining what are the right metrics that you should look at, but also the right recurrency, so to say, the frequency of your business reviews on the Amazon account. And in general, this should obviously be done not only on the Amazon account, but also with all of your other retailers. But for the sake of this webinar, we will focus on the KPIs a little bit that are relevant for Amazon vendors.
All right. And what KPIs are those?
Yeah, good question. I think, of course, you can go very deep, very quickly on the Amazon account, but typically I recommend you look at a few or a handful of KPIs or key performance indicators that really move the needle for your business. And of course, when we look at the sales performance metrics to understand whether you're growing and how much you're growing, you quickly arrive at shipped revenue, your net receipts, but also your shipped COGS that Amazon has actually sent to end customers. Your net receipts are quite crucial to keep in mind because you want to understand, okay, how the trading terms that you have with Amazon vendor materialize and to which extent. But when you really want to emphasize the profitability aspect and you want to understand what is going at account, but also at SKUs, or as Amazon calls it, ASIN level, you ideally take a look at the trajectory of your average selling price, your average cost per unit. So how has the cost per unit, so the cost price to Amazon, fluctuated? What are the trading terms as a percentage that you actually invest, not only the ones that you have agreed with your vendor manager? And of course, this then aggregates down to your front margin. Amazon calls that for themselves the pure profit margin, or PPM. But what you will be constantly confronted with your vendor manager as well is the so-called net PPM, net pure profit margin. And of course, next to that, I recommend also looking not only at the Amazon side of things, so the Amazon profit margin, but also your internal profit margins. Now, depending on in which organization you work, you may have a different reference. Some call it 3-net, 4-net. Others really go by their gross margin, net margin, operating margin. And others, again, say, for example, that it's a gross to net ratio that they are looking at. No matter how you do it, the key here is that you set it up in the way that it is conform with your business and your finance business partner, ideally. But even more so, you not only need to define all of these KPIs, but ideally also ensure that you're comparing them. And a good way, especially in such an anti-cyclic business as with the Amazon trading relationship, it's good to compare your margins, but also your KPIs, such as the average selling price, against year over year, so that you really look and remove all of the seasonality that may come into the mix, and you're comparing your net PPM and your ASP of today with how they performed exactly a year ago. And this will then allow you to really take a look at, okay, do you see individual patterns that work in your favor or even against you? So, for example, if your average selling price is going down, you will also see that, of course, you will see it reflected not only in your front margin, but then it cascades down also to your backend margin. And for that, you also need to have the reference points, because if your ASP is just at $15, 15 euros, 15 pounds, it doesn't give you enough information to really benchmark this KPI against anything else.
Mm-hmm. And how much time is this taking out of one's day? And how often should you be reviewing the performance of the account?
Yeah, so typically I would recommend that teams are looking at it at 3 different levels. And this should be on a weekly basis, monthly basis, and quarterly basis. At a weekly basis, it should really not take too much time once the reporting structure is set up. I would say probably most account managers and most head of e-commerce will probably take half an hour to an hour maximum in order to deep dive into what is going on, what has happened over the last 7 days on their account. And there's literally also no reason why you would spend much more time on it, because you don't know yet whether a certain short-term trend is just a one-off or whether it will materialize into a more long-term trend. So spending a lot of time obsessing about short-term trends at a weekly basis is certainly not the best use of your time. This should really be done ideally on a monthly, even better at a quarterly level, right? So here you should spend also equivalently more time on deep diving certain trends that have fostered into your P&L and materialized more, and where you know that it's not driven by a one-off event, such as an outage or a pricing error or pricing spike that led to a demand spike. And here you obviously need to set the resources a little bit more tightly to actually accommodate for that. I recommend that you spend roughly and half an hour to an hour on a weekly basis to really review it, ideally even on a Monday, so that you can use and review the previous week, and then slightly more depending on what's going on in the business for the monthly and quarterly reviews. And that you also, if you're in a position where you guide a team that is working on the Amazon account, you let them summarize the main drivers for the key and core KPIs. And this is typically your growth and also your margin. And that's exactly also how Amazon does it internally. And you have to call out, okay, at SKU level, why was this ASIN decelerating in growth? Was it because of out of stock? When you look at your profitability, you also want to ensure that not your most profitable items are all of a sudden not available anymore. And exactly these things are typically what you will get a better understanding of once you repeat and you have a frequency in this reporting mechanisms as well.
All right. We have a question from the audience. Someone, is asking, please share with us benchmark net PPM, for example, in the beauty industry, perfume, for example, if we consider weight.
Yeah, good question. It is vastly fluctuating depending on really the category you're going into. In consumer goods categories, you will see that for products that are fairly sortable, you'll probably have a benchmark net PPM of between 28 to 35%. If it's a very heavy and even a bulky product as well, and you have no supply chain initiatives, such as a direct import model or a vendor flex model applicable, then Amazon typically needs also a higher share of the net PPM to offset the higher variable handling and shipping costs that they incur in order to send the product to the end customer. So here, up to 40-45% of the net PPM can incur. But again, it depends entirely on how heavy it is. It will differ depending on also whether it's a multi-pack setting or if it's a single SKU setting, so to say.
All right, great. A question from Tom. What's the best next step for a price increase that is rejected, despite being able to show that Amazon's retail price and net PPM has increased?
Yeah, so typically a cost increase, I mean, no retailer will obviously say, okay, great, we're just accepting the increase without the evidence that also the margin is, so to say, at least stabilized. So if you're facing the challenge that your net PPM has actually increased and Amazon still doesn't want to accept your cost, then it's very crucial that you communicate concrete and concise deadlines. So you're saying, okay, from this date onwards, we'll be unable to ship these products at the old cost to you. And any newly placed POs, purchasing orders, will have to reflect actually the new cost price in order for us to confirm it. Now, if you're set up via EDI, that's a fairly straightforward process to do because you can reject line items at a PO and you do not need to reject the entire PO, just for the line items that are affected by the CPI. If you're not, then it becomes a little bit more frictionful. So here I would recommend trying to automate it where possible. But the firm stance is certainly key because once Amazon sees that an item runs out of stock, then they will also obviously realize that you're taking a much more firm stance and are likely to come back to the negotiation table. It's key that you keep the communication open and that you're very upfront with them around deadlines and that you inform them ideally, if you can, 3 months upfront, and give them also the transparency that, for example, recommended retail prices have adapted in line with the cost increase as well, so that you're not like basically artificially decreasing the opportunity for Amazon to materialize a similar margin level, pricing obviously at the discretion of the retailer.
All right, great. Hope that answers the question.
Right. And yeah, I mean, the second point after you look at your KPIs is really to cater to Amazon's business model. Maybe we're moving into that section a little bit because I think it's quite interesting for a lot of brands to look at. Because if you're looking at a lot of brands' margin challenges, then they're not always, but very often homemade. And that really means that brands haven't fully understood the Amazon business model. They're trying to use shortcuts. They're trying to simply upload their entire portfolio and see what sticks. And if you're following this kind of approach, then sometimes, and especially before the pandemic, this kind of worked well because the uplift of sales was not as extreme for a lot of brands. And thereby you could get away with it, right? Because compared to your other retail customers, Amazon was fairly small and you could outweigh it and balance it. But now, since we've also seen the growth influx throughout the pandemic, I think for a lot of brands, they realize that, okay, all of the homeworks that they haven't really done over the past, they are firing back a little bit. So what do I mean by that? How can you cater more to Amazon's business model? And I would probably split that down into assortment, but also into the overall forecasting of newly launched products. Because what I see a lot of the times, and this is kind of the narrative that Amazon is following, is that they want you to upload all of your products. So list everything that you have, and then we see and we go with the flow, so to say, and we'll talk about the products that don't return a really good margin. Now, this can be a little bit of a challenge, right? Because if you're just uploading everything and you know that you're selling certain products only to discounters, then with Amazon's self-proclaimed price following model, I mean, it's less of a surprise that you will face certain margin challenges or face delistings because Amazon cannot actually materialize a margin that is sufficient enough for them to sell the product at a profit. So what I typically recommend is to, if you have 100 new ASINs, or even if it's just a handful of new ASINs, forecast your margin performance realistically. So don't use necessarily the recommended retail price that we all know is probably not necessarily what also transmits into the market segment, especially if you're selling a lot to discounters, wholesalers, and distributors. But really take a look first at, does it really make sense to have this product on Amazon itself? So does it come in an optimized packaging for e-commerce, or are you shipping the same kind of product packaging that you would have on a physical shelf, on the digital shelf on Amazon? Now, the problem with that is that a lot of this packaging has a lot of air in it to make it appear bigger and to appeal more to the end customer. And that works very well in a bricks and mortar world, but not so well on the Amazon digital shelf. So forecast your margin. And if you know that it will drive a detrimental impact on your Amazon P&L, then probably think twice if that's a good idea, or whether you're rather launching it in a different size format, as a bundle, or even as an exclusive with other retail partners or with Amazon, in order to elevate your chances, at least, of returning a good return on invest from uploading it. And this is really then also segueing us into the definition of whether you're following a full versus a selective portfolio access with Amazon. So really think about whether you really want to make most of your products available to Amazon, or whether you're a bit more strategic about it and you're defining the top hero brands and top hero products that you're dedicating to the Amazon channel, because that really allows you to like almost park the products where you know they are not profitable away from the Amazon channel, sell them where it makes most sense. And for Amazon itself, you kind of use either alternative pack sizes that are sometimes larger, because you know customers who have bought the smaller version of it, they are likely to look for a bigger one and are ready to commit to larger product sizes on Amazon. Or you're actually taking a look at increasing the value for end customers by bundling it together with a different type of product that is also in your range. And you're creating basically an entirely new listing, which also ensures that you're differentiating your Amazon offer way more as compared to what's available in the rest of the market. So I would definitely focus on especially this forecasting of margins and the decision on whether you want to list really your entire product portfolio versus kind of in a selective portfolio access where you become a bit more nuanced on which products and which listings you're actually going to upload to Amazon as well.
Great. We have an anonymous question here, which is how to increase prices and decrease net PPM agreement spontaneously. Do you think it's possible? And on top, retail prices are not increasing.
Yeah, I mean, it's tough to answer that question, right? Because it's tough to understand what the net PPM agreement entails, right? I don't assume we talk about a net PPM target. I would assume, okay, there is a probably ambition from both sides to reach a certain margin. So under that circumstance, I think it's key to understand that a cost price with Amazon typically acts as a way to claw back the margin improvements that Amazon has incurred once the cost increase has transpired into the wider market segment, right? Because Amazon is a price follower, and they are holding generally less inventory than a lot of your other customers. Because if you're relatively small on Amazon but very mature in the offline retail bricks and mortar world, then they have you will have customers offline that buy on pallets or even in full truckloads or container loads from you. So of course they have much more inventory at the old cost price before they have to pass it on to the end customer. So Amazon typically with a lower inventory volume will be affected first by cost increases. So what you can do in order to kind of ensure that your cost increase is more likely to be accepted is to offer any kind of phased volume incentive. And that means that you're offering Amazon up to a certain deadline, a bulk buy at which they can purchase the products at the old cost. And that doesn't interfere with your original deadline by which the new cost has to be accepted, but gives Amazon the opportunity to kind of soften the impact of a cost increase as a price follower. Pricing always at the prerogative of the retailer, of course, but I think this typically has worked well in the past and also with other clients. In terms of decreasing the net PPM agreement, it's really hard to make or to give you an assessment here, because I do not know what kind of products you sell and what the overall situation on your account is, and whether your net PPM is well above the benchmark in your industry or in your category. But I think here you should probably be very critical about whether the new net PPM that you're targeting is enabling Amazon to actually sell your products again. And a good benchmark that you can take a look at is if you have any products that got delisted historically. So what was the actual net PPM of those products that hopefully are similar to the ones that you're trying to increase your prices at? And when, from which threshold onwards, did Amazon scrap them or delisted them? And this gives you a good understanding on how to gauge whether you're asking for the stars and for the sky, so to say, or whether your ask is kind of realistic and you can go towards that direction. So I would, again, adopt a data-driven approach where possible, and then take it really from there. And in terms of the cost increase, you can become creative on how you want to adopt it and also negotiate it with Amazon.
Great, thanks. Hopefully that answered the question.
Yeah, otherwise, happy to answer any follow-up question that you may have. Great. And then, I mean, we're coming really to the third point and third area. And next to deciding on which products to list with Amazon, we obviously also want to take a look at how you as a vendor can improve your margins with your existing portfolio. And I know a lot of brands are currently looking at cost increases. I mean, we just had the question around it. And I think I highlighted how you can become, or at least partially become creative around that. But you also obviously should be very careful where you invest. And what I mean by that is you will constantly face requests by your vendor manager and ABS brand specialist on investing into, for example, deal events. But even if you forget about these stakeholders, you will have probably an internal marketing team or a marketing agency that is constantly begging you for investments into certain listings that they would like to move. And again, if you're coming from a more traditional background, the challenge that you will face on the Amazon account is that especially brand teams will ask to allocate certain funds to certain brands that were predefined. And this is a very typical setup that you will have in traditional bricks and mortar. So there's nothing wrong about that if you're in the offline channel. But the challenge that you will have with Amazon is that, again, they are not necessarily driving themselves demand to one ASIN over the other, so one listing over the other. They see themselves not even as a retailer, they see themselves as a marketplace that simply connects the existing demand in the marketplace with your supply as a brand. So they let kind of their customers decide which products they want to buy and whether they really want to buy your products over and above the available competition. So I think it's very important that you are becoming aware that just allocating certain funds to a brand is not necessarily enough in order to drive the customer demand to products that are also profitable for you and for Amazon. So typically I recommend looking and pulling basically your entire portfolio, comparing which products are margin accretive or at least margin neutral for Amazon, and which products are margin accretive and margin neutral for you internally. And then you get 4 quadrants, which actually highlight which kind of products are mutually accretive, which are only accretive for Amazon, only accretive to yourself, and which are for both parties not profitable at all. And if you have this clustered out, then of course you want to ideally focus on the products that are very profitable to you, but also balance that with products that are kind of profitable to Amazon. There's also the no-brainer quadrant, as I call it. The listing is profitable for both Amazon and yourself. So you want to allocate, based on these 4 quadrants, your marketing spend towards those that are driving your own bottom line. And you also allocate some funds in order to drive Amazon's bottom line so that it balances out at account level. And I think these quadrants need to be defined very carefully without even introducing new selection, but just by looking at what is already available on the marketplace. And this will also help you and guide you to really decide which products you may even want to delist, even though these products may not be end of life, but these products may be very detrimental to your P&L or also to Amazon's P&L, leading to constant requests of your vendor manager and automated systems to ask for margin support, margin compensation, and so on. So definitely make sure that you're looking at all of those and that you're also ensuring that you're constantly reviewing that, right? It's, again, similar to the first point. You do not want to conduct this exercise only for once. You ideally want to do it probably at a quarterly or half-year basis so that you're constantly looking at, okay, which products should I drive a little bit more? And this will lastly also help you whenever your vendor manager or your brand specialist says, look, I want to promote these products, to quickly understand, okay, are these products actually the quadrants that I'm intrinsically motivated to push, or are they very detrimental to my profit margin, and thereby I will simply reject their demand of like pushing them in deals or pushing them elsewhere.
Great, thanks. We have a question from Alexander. Hi, Lauren and Martin. Regarding also improving margins with having high order volume, what's your take on direct sourcing model? Since Vendor Manager is really pushing us here to participate in EU7, does the direct sourcing delivery model make sense from a profitability standpoint? Would you recommend to roll it out per marketplace or full pan EU?
Yeah, great question. I mean, if you're in a product category where it makes sense and where you manufacture products in, for example, China, then an FOB or direct import model is certainly something that you should look at, because it enables you to really remove the risk of any availability issues. And you also shift the risk more towards Amazon, right? When it comes to the delivery. And the intrinsic benefit is that Amazon has typically very good cost agreements with the freight companies that they're using. However, and this is what you hinted upon, is there is a greater risk associated of unintended cross-border sourcing, as Amazon may leverage this kind of earlier product ownership for their own distribution between warehouses across Europe. So that may mean that Amazon is sending it also into locals where you do not have an active vendor account, right? Because they can actually source it from you. So it depends on your individual business case. I would always factor in the cost benefits against the risk that you see from a cross-border or unintended cross-border sourcing perspective. If you feel that you're fine with that because you're having an active vendor relationship across EU8 marketplaces already, then I think there's nothing to be too concerned about, because you will have a cost price or a net cost price with Amazon that applies to one direct import account and caters to all of the marketplaces. So there's also the intrinsic cost benefit that you yourself don't have to deliver to all of these marketplaces. And on top, you also typically incur less chargebacks for non-compliance. So this is certainly something that you should weigh against and make the business case internally, ideally with your logistics department, but also with your finance business partner, and works quite well for a lot of brands, especially in the hardlines industry. So if in doubt, maybe also talk to consumer electronics vendors or brands that are Amazon vendors, because they're very likely on a direct import model.
Great, thanks. And yeah, how do you think brands can utilize major deal events, such as the upcoming Black Friday, to drive their bottom line?
Yeah, I think it comes a little bit down to what we've discussed earlier, right? You really need to understand which products are really the ones that are interesting for you from a profit standpoint. And you need to balance that out against, of course, your brand needs and your brand team's needs, as well as to look at how you can strike a deal with Amazon in order to drive your NPDs, because new deal events such as Black Friday and Cyber Monday always often post the opportunity to negotiate a mix of, let's say, for example, 70% of your top sellers. And you can then negotiate with your brand specialist or vendor manager that they have to add in newly launched products into the mix. The only requirement that typically they have is that they have kind of all of the content available, and that they have already gathered certain reviews that ideally are above the 4 stars mark. Exceptions apply and are possible, especially for highly seasonal products that are just being introduced right before that. But it is then at the discretion of Amazon to really whitelist these products. And lastly, don't only obsess about Black Friday, for example, itself. The week before Black Friday works very well as well. I've seen vendors being up to 80% as successful in terms of sales volume on the Friday, 1 week before Black Friday, while you often do not have to pay the same rate card as for the Black Friday participation itself. So also there are opportunities to kind of protect your bottom line, protect your investments, and offering lower deal invests than you would otherwise have to offer.
Great.
Great.
Anything else you'd like to add, or we should jump into the next part?
No, I think that was all from my end. So I think everyone is now very keen to hear from you around the talent part, how you can find the best talent for your team. and also ensure that everything that we've discussed and obviously everything else that belongs to proper Amazon management can be done, and you find the right team members for it.
Great, great. Well, I'd also like to hear from you. I'm going to give a bit of like what I've seen in the market. But I also think it's interesting, you having worked in Amazon, but also having worked with the likes of blue chip multinationals. As I was mentioning, most of my experience has been recruiting for FMCG companies, Danone, Logitech, Mattel. And it's been quite interesting to see, how e-commerce has developed, because ultimately it first came in as a type of commercial profile. So they got a key account manager from Tesco and said like, okay, now you're responsible to figure out what's going on this internet thing, and how those skill sets have developed. So like when I see the first e-commerce roles come into FMCG companies, it was very much looked at like a sales role. So they said, traditionally benchmarking, okay, what's the size of the P&L that they've managed? Because that shows the importance of the account. And what you saw, at least what I saw, is that there was a bit of like rogue candidates that ended up in e-commerce because they were prioritizing, Carrefour, Tesco, these bigger accounts. And it was really like, very curious individuals that ended up there. And ultimately are now the people, probably some of them are listening now, are now the people that have like a very unique, highly demanded skill set. But I do think in the beginning, they really took a risk because it wasn't the place where high flyers, or where, not necessarily high flyers, but it wasn't the place that people said, oh yeah, I really want that job because it's going to have the spotlight from the CEO, where now it does. Right. So I think it has been very interesting. And what we've worked a lot on is really over the years, learning ourselves and then coaching our clients on like that traditional way of looking at this profile doesn't really matter. It doesn't matter the size of the P&L. If you're trying to get your business from 1 million to 100 million, that's not the same as a key account manager that's worked on Carrefour. That account is, 500 million or billion or 3 billion or whatever it may be. So I think it's important to really look at, what do you really want this person to do? And really define that, and not use very like traditional benchmarks of what a successful sales or marketing person looked like in the past. And definitely, I think looking into smaller companies, startups, scale ups, I think a lot of FMCG companies, they really want to look at what their competitor is doing and then try to take people from the competitor, when actually it doesn't matter what the competitor is doing, because you should have your own e-commerce strategy and your own plan. I would say the only watch out there for taking individuals from startups or scale ups, and maybe there's more, but the one that I've realized more is that there is a piece of managing internal politics that is very, very relevant inside of large multinationals that in startups doesn't exist as much. So they may need a bit more support of like navigating through the organization that in a startup is quite basic. But yeah, I wanted to ask you as well, like, what have you seen? And also like, what behaviors do you think make successful candidates in these types of roles?
Yeah, absolutely. I mean, I've recruited for Amazon myself, so I think it's very interesting how it has shifted, right, from a very peculiar, I would say, customer to one that is very sought after in especially large multinationals, but obviously also for smaller companies. You see it also on the seller side of things, where of course Amazon is now almost the only way next to the Shopifys of the world to really go after it. From a talent perspective, I think you're right. Before, I would say, like also when I started at Amazon 2017, 16, like there were a lot of folks working on the Amazon account that really came also from a traditional bricks and mortar background. And a lot of them have obviously stayed and are still working on or have segued into the Amazon management. And I think while it was often an account that was quite unthankful to work for, simply because, as you mentioned, it didn't get the attention from, nor the budget often, by the way, from the internal stakeholders. I think this has shifted a lot. But with this shift have also come a lot of new priorities to the positions itself. And I think when we compare even nowadays the management of the Amazon accounts to the likes of managing Tesco and what staffing exists, then not in all, but in a lot of companies, the peculiarities are still not properly addressed. So the typical example is that there's no dedicated finance person who really understands how e-commerce works, or even the Amazon account. With all of the shortages, chargebacks, etc. And then there's a little bit of confusion how the P&L is actually set up, not only on Amazon side, but also even for the vendor itself. And oftentimes then account managers have to kind of offset that and do a lot of what otherwise a dedicated marketing or a dedicated finance person would do. So I think what I've seen now over the last, I would say 12 to 24 months is that, yes, there's more awareness around that, but we still have a lot or a long way to go to really also shape the kind of organizational setup that a successful scaling of the Amazon business really requires. And especially in European marketplaces, I think most of our attendees will agree to this. It can be quite a headache given that Amazon is rapidly developing at such a fast pace, making it very key for brands to keep up with their European structures and negotiating at a pan-European level, whereas most vendors are still set up at a local level. So I think, it's not necessarily stopping to evolve. I think there will be a lot of challenges that brands need to address. And for that, what I think as a profile is very key to have in a team is somebody with a very agile mindset, very data-driven, that can read a P&L and also understands how the commercial aspects really work against and in your favor. And in the case, and as long as Amazon has its vendor model, also very strong negotiation skills, right? Because Amazon negotiates slightly differently as compared to traditional retailers, and to understand the patterns and to really educate your teams to negotiate almost at every point in the business relationship, not only when Amazon knocks at the door and says, hey, we want to renew our terms with you. That is quite important.
Yes, which kind of goes in line with this question of what do you believe are the most important capabilities for Amazon account managers? I would like to dive into, I know you said data-driven, agile, negotiation skills. The negotiation skills piece, if you look at, for example, the Gap partnership, which is a famous, let's say, negotiation training, do you think that they can also train well to work with Amazon specifically because it was a bit more traditional, or where do you think you can go to develop the best negotiation skills for working with Amazon besides, I guess, working at Amazon and then helping people?
Yeah. So, I mean, look, I think I would generally say it's a good starting point, for example, with the Gap to really understand how negotiations work, because it will help you throughout the year to really have this commercial mindset and to really foster that in a way. But on top of that, I would always encourage brands to look at somebody who's really Amazon focused and either comes from Amazon itself or has negotiated on the Amazon account for at least, I would say, 4 to 5 cycles. Anything below that will entail a lot of successes that may be one-offs or that are just happening because you had a good year and, for example, your ASP was inflated to one-off effects. But if somebody can really consistently give you good results as part and as a result of a negotiation, is also quite creative in finding solutions outside of just increasing terms year after year, which clearly isn't sustainable, that is certainly something that I would look for. Without having the shaming plug here, I offer one of those JBP negotiation trainings. So if anyone is interested, happy to reach out. But otherwise, I think it's always a good starting point also with these traditional negotiation trainings. Just know that Amazon is very likely to try to disrupt that as much as possible, and that a lot of email communication back and forth will happen rather than the typical negotiations where you try to form a relationship, where you try to meet in person and also resolve kind of tricky situations such as in an escalation via the phone at best or even in person.
Great, thanks. She's also asking, how do you test those skills, which I can give my suggestions. I have a list of specific questions that I'm asking during the interview process, but we also use a psychometric assessment called Success Finder, which is very, very strong. I actually think Amazon uses SHL, if I'm not mistaken. But I know that there are various ones. Some I prefer over others, but I think anything that can help to measure behaviors and how people are going to react in certain situations, and it tests agility, learning agility, flexibility, all of these things it tests. I think that also always helps, because even myself, that I've interviewed thousands of people, some people are very good interviewees, I should say. So even after you ask them the best questions and they seem like the best candidates, I always think any kind of, a valid psychometric assessment always helps to test that at the end. Great. Anything from you, Martin? Any other ideas on how to test how to test that?
Yeah, I mean, it's always good to, I think Amazon does follow the STAR method. So they really want to understand the situation, the task that was performed, the action that you've taken, and the results that it has created. So I think especially the last part is something that I would obsess about if I were to hire on the Amazon account or for the Amazon account, because no other account probably shows you the success or failure of your actions as quickly as Amazon, because they have very rapid innovation cycles. They test and learn very quickly. So you want to have ideally candidates who are able to assess a situation correctly, who can map out the kind of tasks that are available to them and the route that they want to go, and also to give you an overview of the actions that they have performed in the past. And as a result of that, it doesn't even matter if it's a negative result or a positive one necessarily, but you want to obsess about a quantitative result. It can be an indexed figure if they're worried about breaching their NDAs, but get really to the nitty-gritty details on why they believe it is a success story that they're telling you, or maybe because, or why they think maybe something was the wrong decision also from their leadership. And if they can back that up with data, then it's usually a very good sign that you have somebody sitting in front of you who will be able not only to look at it from a commercial aspect and to kind of use the negotiation tactics that they have learned, but also to really assess on a repeat basis whether the actions that they have taken have resulted in a desirable or undesirable state, and they can reiterate from there. And that's really what I personally always look into when I support brands on that, and when I have also hired in the past.
All right, thanks. So I also wanted to use some time to discuss around, how do you attract these talent to your team? I think, attracting digital talent, they usually want to work for very cool digital brands like Zalando, like Amazon, even looking at Adidas, who has really scaled up their e-commerce capabilities as well. And we've been helping, let's say, more traditional brands, 100-year-old companies that really sell their success over 100 years, how to really position themselves in the market to attract great digital talent, which isn't easy. So I wanted to spend some time to just speak through some of the tips that I've given. I think the most important place to start is what is the story that you're trying to tell? If it's just, hey, we want to kind of test and learn and see what happens, that's not really going to attract very many people. So why is digital important to your organization? What impact can that individual make on the organization and, let's say, the overall business strategy by coming into that company? And I think transparency is key. So if just be honest about the actual maturity level. I've seen companies try to sell that they're more advanced than they actually are. And candidates don't like coming into a completely different organization than was described in the interview process. So I think if you tell a story of really building a digital first organization, how you're going to do it, why you're going to do it, and what's the impact that they can have, I think that storytelling can be very powerful to attract very, very good candidates. I also always mention that, if your brand isn't showing what normal digital talent is used to seeing, risk-taking, forward-thinking, innovation, failure, test and learn, if your company's brand isn't showing that, it is good to maybe go and sit with employer branding and look at that and think, hey, how can we give an edge if that is really what we're trying to do, the type of talent we're trying to attract? How can we show that through our branding as well? Another thing that we've used that works really well is creating a video job description. So doing a kind of 3 to 5 minute interview, well, it can be an interview, or it can be a monologue. You can do it yourself as the hiring manager of the role you're looking for. What are the opportunities? Why should someone join? Challenges, behaviors you're looking for, really, let's say the highlights of the job. That's worked very well. We actually do that with all of the hiring managers for all the roles we work on, even if it's like a traditional vice president of Europe role and has nothing to do with e-commerce. Because the point of the matter is that the market is very, very, very tight right now. So you really need to wow candidates. And by a written job description, it's just really tough these days. So I think the video job description is a great tool.
Where would you upload that? I mean, I fully get it. It gets really a nice personal flavor, but what is the perfect platform to upload it? Is it LinkedIn in your opinion, or would you upload it anywhere else as well?
It depends. It depends on how big of a reach you want it to be. Me personally, I would probably do it to LinkedIn and then ask my network to share it. If you have a YouTube, you could also use, like, if the company has a YouTube, it kind of depends. I do think blue chip multinationals, like, they're not going to upload it to their YouTube if it's just this guy saying, you know, everything needs to be in line with branding and everything. It needs to be done very professionally. So I do think LinkedIn is a great platform to use. Or another thing, which I guess still might need a bit more sign off, is like on the actual job description, if at the top of the landing page you have a video, that could also work, you know, so that when people actually see it. Or I think LinkedIn would be best, because you can also run the video. It can play live. You know, if you post a video directly to LinkedIn and then you can put the job description in the comments, I think that would probably be the easiest and fastest way to do it.
I love that idea. And I think not enough companies are doing it yet. At least in my feed, I don't see it enough yet.
No, and it is scary. So let's be honest. It's like no one likes seeing themselves on a video talking about, you know, but honestly, if you want your team to be the best and you want to perform well, you have to kind of put yourself out there sometimes. And I think that's another piece that attracts them to show, hey, I'm not waiting around for candidates to apply for my jobs. I'm going to go out and find them kind of mentality, you know. I think as well, like, looking at job boards, I know we're both in touch with the Digital Shelf Institute. They have a job board, and trying to investigate other organizations, other networks where you can post on their pages, on their job boards, is something that I know this is all like you taking the responsibility. And I would say that's the point here, that if you wait for the internal talent team or HR to do these things, they're probably not going to do it. So these are things that you can do on your own to look out for and write people and have those jobs posted. I think as well, once you do a video or even the traditional job description, to make sure that people in your network are sharing it. I think sometimes people think like, oh, I don't want to bother people, ask them to share that. But if you find like 5 very well networked people from your network that work in e-commerce and ask them to share it, you'll get 100,000 views. So think about, you know, which people you can ask and how you can really get much more visibility. And of course, it would be better to be a video. But if it is just the traditional written job description as well, getting more reach would be great through getting your network to share it as well. You can also hire a specialized agency, not just us. It can be any agency, but hiring an agency that's very much networked very well in that specific area, whether it be specifically with talent that have worked in Amazon or specifically direct to consumer, people that have run their own shop. I think in certain instances, it helps, it definitely speeds up the process than, you know, waiting around and trying to find certain talent on your own. Definitely having a flexible working policy is key these days, especially with digital talent. So if your organization does not have a flexible working policy, I would try to really push for that as much as possible, because it is very, very, very difficult in this market to find talent, especially digital talent, that are coming into the office. So I think that's also very important. And then I think lastly is really having a learning and development plan in place. And I think from learning and development, what has really shifted is the traditional, like, set out yearly developmental goals and then have a yearly performance review. I think that's shifting a lot. It's much, much faster, and it's development in smaller doses, if I can say that. So even if you look at like Power MBA or other types of, you know, online courses and these kind of things, it's not necessarily about the traditional MBA anymore, even though that's still very helpful, but looking at smaller doses of learning and development along the way. I think that there's many more individuals that are looking for that instead of everything being on kind of like a yearly planning cycle.
Yeah, totally. And I think everyone, especially no matter whether they are working remotely or in person in an office, they obviously want to constantly learn. I mean, it's very intrinsic to a lot of people that are working, obviously, also in the e-commerce space, because it is such a fast-paced space and it requires you to really keep up with everything. You mentioned as well the flexible working policy. I mean, what is your overall sense? Where is the market going, and what should you do if you are a hiring manager, but maybe your company doesn't support a flexible working policy? Is there space to negotiate it internally, or what would be your recommendation there to still be attractive for a prospect?
Yeah, I think it depends market to market. So I know in the US, for example, most of the companies, they're open to people working flexibly from different cities. I would say in Europe, it really depends. I think in Western Europe, moderately flexible, but then when you get to markets like Switzerland or the Netherlands or the UK, dependent on tax regulations and different agreements that companies have, it also becomes problematic. I do know that the companies are working on that, but it isn't going to happen overnight. So there are still companies that need the person to be based there. And I've also heard a theory from FMCG companies, which is we're a product company. We have people in the factory and they need to be on the ground in the factory. And we're creating things that to live 100% digitally doesn't work for, let's say, our company culture and what we are actually producing, which I can understand. So I also think like if you look at, more software service companies, it's a bit easier for them to say, yes, 100% home office, we're digitally focused anyway. But if we're actually delivering, making, innovating products, people need to come together. That maybe or maybe not true, I mean, I can see where they're coming from, but I think it has been a big shift for many companies that were 5 days a week in office, completely home. A lot was going on during COVID that finding the right balance, I think, is difficult. I do think that with most of these policies, it's really going to come from the top. So if you're the hiring manager, the person that you probably need to convince not first is the CEO, So I think it has to do with the board and really understanding why is this so important to see, is it like deep rooted culturally, or does it have something to do with legal regulations, or kind of where is it coming from? But I definitely think now it is getting more and more flexible, but I do think market to market, it differs a lot.
Yeah. I think, the next couple of years will be quite interesting in that regards. I think everyone will agree, depending on where they work and what they've also seen happening over the last couple of years now in their organization. But definitely a space to watch. I think even if you're hiring somebody, I mean, that's obviously something that you probably want to understand a little bit more deeply, right? Because these questions will come up from potential candidates. And I think, as you mentioned earlier, it's becoming more and more important, at least to understand, okay, do I have flexibility mid-year, even though I have to be in the office maybe 90% or 80% of the time? Is there an opportunity to at least negotiate as part of also the hiring agreement, maybe a month to work abroad every year or a couple of weeks? So I think that's always also interesting, right? To look internally, also to work with your HR department. Is there any opportunity to bring that in and bake that into agreements? Because especially when you're on salary negotiations, that may be something that you can also bake in, and that can be quite attractive for candidates, especially in a market where candidates are a little bit more rarely seated than usually, I would say. Great.
Well, yeah, just to summarize, Martin, you go ahead first.
Sure. So if you want to elevate your profit margins with Amazon, I would always recommend obsess over your KPIs. Look at them and define the crucial KPIs. Also do that on a frequent level, weekly, monthly, and quarterly. And when it comes to the second area, really cater to the Amazon's business model. Understand that Amazon is a marketplace first and a retailer second, which also should bring you to the decision on whether you want to really list all of your products or rather a selective part of your portfolio. And third, also actively manage your portfolio mix. So make sure you are very much aware of which products you're promoting, which products you're focusing on, and use the 4-quadrant metrics, so to say, that we've discussed earlier, in order to really understand whether you want to support the vendor manager or brand specialist requests to fund products, or whether you're opting out from that.
Yes. And if you need more information, you can contact Martin. And for myself, from the talent perspective, would be to clearly define what you need the person to do for each specific role, and also focus on selling your vision in the recruitment process. And if you may be looking for talent for your team, or also looking for a job yourself, do feel free to reach out to me on LinkedIn anytime.
Great. Thanks, everyone, for joining. It's been a lot of fun. If any questions are coming up, feel free to reach out. I think everyone can contact us also via LinkedIn. So if you're not connected yet, feel free to connect with Laura and myself. And we're looking forward to hear from you, and wishing you a good, nice rest of your week.
Yes. Thanks, everyone.
Thanks,
Bye.
everyone.